Episode 59. The Great Myth of Diversification.
We're getting close to 100, Frankie.
Michael Jordan wasn't good at golf, basketball, and baseball at the same time. Warren Buffett didn't invest in crypto, stocks, property. He only invested in one asset. So today, the topic is the Great Myth of Diversification. And I've got Adrian here, who I want to compete with, or not compete, debate with.
Yep.
As he's an advocator, you could say, or he's an investor of stocks and property, which I do have stocks as well, but I haven't purchased a stock for many, many years. Mm-hmm. And we want to talk about, I guess, I'm a believer of diversification is an absolute buzzword that people like to use.
Yep.
And I think it's used a lot from financial planners or advisors, and they say, oh, don't put all your eggs in one basket. And we get it a lot with clients because I get that advice. And I think it's an absolute
load of shit.
Yeah, load of shit. And when I look at the greats of the greats,
Yep.
they've only done one thing.
Yep.
And they focus on one thing and being the best at that one thing.
Yep.
And so I know there's nothing wrong with doing different types of diversification. I think eventually you want to kind of aim into that field.
Okay.
But I think we want to shed some light on that today and talk about it.
Awesome. I bought stocks literally last night. So every single month I put money into stocks. I'm putting an offer. It's actually very funny. Last night I bought my monthly contribution to stocks. This week I'm going to buy another asset. So this is a perfect week for us to have this conversation.
Why stocks?
Why stocks?
You run a company, you run a buyer's agency, but why stocks?
As in, why stocks over...
Why do you buy stocks? Why not just put it all in property?
One, I understand stocks. So I've underwent the course. Now I think both of us, we've fucked up on this. We've gone into gold, and we're going to talk about that today. We've gone into gold and crypto, and you've done shorts and longs and, option trading, and then stocks and property. Why specific stocks? Because one, you can build serious wealth through stocks, through trading through stocks. Now, again, just long-term trading, very much Warren Buffett.
Trading, because some people might think you're trading the markets.
Yeah, fuck no, not doing any of that.
What are you doing?
I'm literally picking the best of the best stocks, very much blue chip stocks, your Apples, your Amazons, your Berkshire Hathaways, your Novo Nordics, your very, very, billion dollar companies, things in the S&P 200. I've got LVMH, like European stocks. Buying that, holding it forever. Buying when it's cheap. So yesterday I went and bought a whole heap of Novo Nordic, a Danish company. It's trading 20% off its 52-week high. Bought that. And I bought a bit of Apple. It's trading cheap. I'll own this stock, maybe not forever, but for 20 years, 15 years, or when something potentially happens. That's all I'm doing. So I've got my 10 stocks. I buy them every single month. I just buy those particular ones. I've also got a course I'm part of, which we've gone to. It's definitely not trading. I dedicate 2 hours a month to it from a time perspective.
And
3 hours a month.
What's the return since you started with this company and this course? Do you know off the top of your heads?
Yeah. It's well and truly beaten the S&P. So the whole mantra around this is that you trade yourself. You don't just put it in, one of the indexes, S&P 500 or something like that. So my return has been around that 16%. So it's pretty cool. Over a 20-year period, it will literally fund my lifestyle.
When you say 15, 20%, you say an annual return, like since you started?
Yeah, correct. So I've been doing it now 2 years. Yeah, for the 2 years that I've been running it. Last year was a bit higher. This year's had a bit of a lull. On average, I believe it's around that 15%. So it's done really well.
S&P, looking back at it, I think it's 7%, 8%?
10, 8 to 10.
Depending on what average or how many years you go out by, but yeah.
Yep.
So you've been in the S&P 500 for the people listening. S&P 500 is the top 500 companies in America.
Yep.
On stock exchange, and you can invest in that index and you can invest throughout all of them.
Correct.
So,
yep.
Okay. So I think my take was, I started stocks a different time than you. I think it was 2018, 2019.
Yep.
I got into option trading.
Yep.
And I remember during that time I was learning and reading as much as possible. And I went down this road of reading and listening to all these things, and you start gravitating to...
What's that?
That's hydrogen water, mate. Just went off. It means I've got to drink it right now.
Well, you better start drinking it, otherwise you're going to turn into a frog if you don't drink it.
So what I did was I went down and, started reading about property, got into property, started saying, I'll go get into stocks or diversify. So I listened to all these podcasts and listened to all these people, got into stocks. So what I did is I went to a seminar, bought a course, option trading. People don't know what option trading is. You buy a company, so you can buy a stock and sell it for a future price, saying you're predicting that price is going to go up or down in the future.
Yep.
And you get cash flow. And if it goes above that price, you get the equity gain as well. So it's a little bit complicated, but it's just basically buying a stock and, saying, I'm going to buy Apple today for $100. I predict it's going to go $110 in 5 weeks' time or whatever it may be.
Yep.
And then you get cash flow and you get equity on that.
Yep.
So I was doing that. I was doing quite well 2019. During COVID, I was doing okay. And then at the same time, I said, I'm going to get gold and silver. So I was reading about Robert Kiyosaki, talking about gold and silver, bought gold and silver, physical. I think I bought it. I've done pretty well with it in a sense. It's done pretty good. And then I got into Bitcoin and cryptocurrencies as well. Because I'm like, keep diversifying. You got to diversify that portfolio. Well, I have the 4 assets. One property I got ripped off by a buyer's agent, bought 2 properties and they went backwards in value.
Yep.
Stocks were doing well, but then you had COVID, and then the drop off of COVID. I have 2 companies that went 50% loss each. Yeah. So I've got money tied up in that.
Yep.
It's like 30 grand, 35 grand roughly is tied up. Can't do nothing. I'm not going to sell it. Done well in crypto because I got in 2020 when crypto was like 10 grand, or Bitcoin was 10 grand, and everything was like, Ethereum was like $200. So I got done really well in that. And then I got into gold and silver, which is done well, but just by, getting into it, I haven't kept investing in any of these things. So I never kept investing in any of them. Bought my crypto, bought my stocks, bought my gold and silver. But then over time, I just kept thinking about you can only be really good at one thing. And that's where I think for me is like, I know more about property. I just kept investing in property, and the returns we can get probably far outweighs when I look at trying to diversify and put all my energy into both.
Yeah. I mean, I think, and we did the exact same thing, right? We would call each other every single day. You were driving your trucks and I was driving around, and we'd call each other and be like, we've got to get on this because it's what the rich, we had no fucking idea, right? And we bought everything. I think we've pretty much got the same portfolio, gold, so we have everything the same, right? Even today, property, obviously now I put, every month I put, 20% of my income into stocks, right? I agree. I think you're very silly if you're trying to chase 5 different things. The reason why I actually do, because I didn't actually answer this question before, the reason why I put, don't get it twisted, I've got $4.5 million worth of property, and I've got a stock portfolio. I don't care to say it here. I've got stock portfolio of 250 grand, right? 95% of my portfolio is still in property. Now, over time, I think you said this right at the start, this needs to change. There's too much risk on us as investors to have $50 million worth of property, in my opinion, and nothing else. Like, shit could happen with the property. I don't know. But me personally, I sit a little bit more comfortably with the fact that, I want to get my stock portfolio up to a certain amount. I want to get up to $2 million. I want to move that into a self-managed super fund. I want to be able to take the income from that and derive from that. Like, I've got my plan with that and I understand that. So for me, it really, really works. Is there an argument that I could have put all that money into another asset? Yes, and that's probably where your mind goes. I don't know. Honestly, I don't know. But I thoroughly enjoy it. If I'm honest, I actually enjoy looking at stocks more than I look at property.
So if you're getting a return, for example, you bought Bundaberg, it's done 115% roughly your property?
Yep.
That one?
Yep.
If you can do the same thing over and over again, I argue and say, well, why don't you just do that again instead of putting in stocks?
And I'd be lying if I said I wouldn't. Like, it's probably, I wouldn't say silly, but let's be honest, you probably can get a better return. You do get a better return, right? Let's be honest. Every property I've bought, buying it correctly, does 100% growth in a 4 to 6 year period. It's probably going to be a better return than my stocks. but I thoroughly enjoy that. Like I like watching the video that I'm part of the course. I enjoy doing that. And for me, it's like, it's 20% of my income. I might in 10 years time go, fuck, I fucked up. But that's the choice I've made, I guess. And to be honest with you, it's also really nice owning that piece. As we spoke about in the previous podcast, I'm very disconnected from my property portfolio. I've got no idea what's going on. I've got no real interest, but I don't take it. I've got people in place doing it. For the stocks, it's all on me. I run my cousin's stock portfolio. I really enjoy that. I enjoy looking at the videos. I enjoy that. It's maybe more of an enjoyment thing, potentially, but also at the same token, I still need to have a return. Otherwise, it's a waste of time. So I hear ya. I
reckon by the end of this, I'm going to convert you back to property, mate.
Maybe you will.
If I can get that money out of stocks right now and I say, hey, Age, I'm going to go buy a property, whatever it's going to be, you got 250 grand, let's go buy this. Your stock, let's just say you're getting 15% annually. Let's say for the next 5 years you get that.
Yep.
If I say I can do 24%, would you do it?
Probably not, because I'm emotionally tied to the stocks. I love the stocks. I do. I really do. I was talking about this with Rawad. I would probably rather, and it's just weird, it's just like an emotional thing, which is bad investing if we're honest. I'd rather cut one limb off than sell some stocks.
So I think people listening to this, I guess it's good because you're going to get people that probably agree with you.
Yeah.
People may agree with me as well. Who knows?
That's good. Let's roll through. Go roll through what you've got to roll through.
I think it's, I always argue, and I think I learned this from who I'm not really a big fan of, but I think it was Grant Cardone back in the day.
Scam.
And he said, diversify is a scam. He goes, you should put all your energy into one thing and be great at one thing. And I truly agree with that.
Just choose that's what he would have said. Yeah, you got to put it all in one thing, but you got to be my thing.
Yeah, by his thing.
Big scam.
But it made sense. And I was like, okay, that makes 100% sense for me. And that's what I've kind of done.
Which, again, so can I just pause you?
Yeah,
can I pause you? I'm on the same page.
Of course.
98% of my wealth is tied up in property. 2% of my wealth, $200,000 of my net wealth is tied up in stocks. So I just want to reiterate that. The reason why I choose stocks is because if you actually do it properly, there's a lot of benefits to stocks. 1, there's no tenants. You're not dealing with humans. 2, you're not dealing with fucking bullshit interest rates. There's no repayments on it. Very easy to hold. 3, if you actually go about it in the right way and you get your portfolio up to $1 million, $2 million, it's essentially a bank flow, which I can maybe touch on that a bit later. So I am also excited to get my portfolio up to $2 million because for me and my family at 65 years old in 30 years time, that will literally act as a way for me to take cash out 200 grand every single year.
The only thing I question is if something happens, someone says something, war, this, that, market can just
in the short term.
In the short term. But it does have, like I look at my stocks that I bought Intel and the other one was AA, I think it was an electricity company in America. They've gone 50% back and they haven't gone back to where they were during COVID times.
So I'll say this
companies.
Exactly. So if you're a shit stock investor, you're going to get, but the same with property. If you're a shit property investor, go buying in a fuck town nowhere where there's 2,000 people and someone removes the, agriculture, sector from that particular region, your property market's going to drop. If you're investing in Apple's got a moat around it. Amazon's got a moat around it. LVMH's got a moat around it.
What do you mean by moat?
No one is coming in, at least in the next 5 or 10 years. You can't say for 30 years because,
things can change.
Things can change, but no one in the next 5 years is coming around Apple and is going to go, hey, Apple, we're going to remove, they've got everything. You've got an iPad there. We've got our own iPhone there. We've got laptops, all Apple, everything. Once you're in Apple, you're in Apple. LVMH.
You're in the network.
Like it's a moat.
Yeah, of course.
You need trillions of dollars to come in. And then that's not even going to guarantee that you're going to throw Apple away. So that's what I'm saying. These markets, they might have like Apple's down 10% off its 52-week high. Most people look at that and go, oh my God, Apple released some bullshit. I look at that and go, beautiful, I'll buy some more. Thank you. And that's what I've done. And over time, it's going to be very difficult for me to fail in stocks, much like it's very difficult for us to fail in property.
Okay, makes sense. So just buying blue chip, holding on companies that just can't go bust or there's any risk from other industries coming in or other companies. That's what you look at.
Yeah, I mean, I look at a whole bunch of different things. Like I look at yeah, a whole bunch of different things. But yeah, well, let's get on with that. We'll try and convince me.
Done. Also, let's look at this. I'm going to just pick on the Australian Stock Exchange. So we'll go to the ASX 200, top 200 companies in Australia. You can just invest in that index. You look at their average annualized growth since 1995 to 2025 is 8.6%. ASX.
Which I don't invest in.
Which you don't invest in. But I thought I'd do it because, today,
Happy days.
viewers. The S&P 500, I think, is around that 8 to 10%.
Yep.
Okay, when you look at it on that same trajectory.
Yep.
Okay. So what I look at, and this is where I look at the ASX, for people, I get a lot of people that do invest in that, a lot of clients of ours as well. The annualized or the return on investment since the last 30 years, you've got 260% it's grown by, not including dividends. Okay. So that's how much the ASX has grown by.
Okay. That's pretty cool.
So not bad. When we look at S&P 500, I think it's a lot more than that. I think it's increased. Let me scroll down here. 460%.
That's pretty cool. So, in 20 years, 30 years.
Yeah.
30 years.
But I wanted to just keep it all on.
100% give or take.
Yeah, give or take.
Which again, we're talking not apples for apples, so I just want to hold you accountable here. You could be talking about the Australian property market.
And then the American property market, which is completely different.
No, but I'm not saying that. I'm saying you're talking about the entire, if we talk about this in property, you're talking about the entire Australian property market, but then there's Bundaberg in 4 years did 120%. So different apples for apples.
We start, if I start individualizing it to Macquarie Bank, Commonwealth Bank, or, then I go Apple and Amazon, it's completely different. Yes, I do agree. Also, I just want to look at it because most people just do the safe option and they go for the top companies and invest in that. Okay. Same like when people invest in a capital city, they want to invest in a capital city. Why? Because they think security.
Yep.
But we'll debunk that in a second as well. Gold. I want to touch on gold and silver.
I'm completely out of my wits with this one. I do hold gold and silver, but got no idea. So
what do you reckon the return on investment is in the last 30 years?
I don't think it'd be as nowhere near. Maybe I'm completely wrong. I'm literally having a stab in the dark.
460%.
No shit.
Increase. Yep. Since then.
No shit.
And I'm going off and I'm stopping off at 2024, not going on 2025 prices because we haven't finished the year.
Yeah.
So I've done it for the calendar. So yeah, you could say 29 years instead of 30 years, if you know what I mean. So
if you want to be pedantic and jump in the comments and get angry with us, you can do that.
Now there's some pretty good swings with gold. You've had years like 2007, 31%, 09, 27%. 2010, 26%, and that kind of, increases over time. 2020, 25% during COVID, and that's when we've seen a lot of money printing. So gold is one of those things. If you look at 2007, you had the GFC that kind of just before it started hitting, and same with, 2007, 2009, 2010, the market grew literally nearly 90%, 100% nearly, 90 to 100% during that time because of inflation. So gold's a really, really good thing to protect your money. Now, do I invest in gold? Have I kept investing? No. Okay.
Yeah, it's also one of those assets that people go to when shit gets a bit uneasy and they go, oh, we got to go to physical, like property.
Yeah, of course. Okay. And look, gold, you put your money in wealth like that, it does store value because it will never go down. It's gold is something that holds a lot of value, but it's something as well you don't get a return of cash flow. It's just an equity position.
Yep.
Silver. What do you reckon that's grown by?
Not as much as gold.
Nearly.
Yeah.
430%.
No shit.
So silver's actually quite a good asset. I was actually looking at it. They use silver for a lot of things like, you look at these EVs and stuff like that. You look at solar panels, renewable energy projects. All of that is used with silver. Silver's actually more scarce than gold. Cool. So pretty interesting. So next thing I want to touch on is capital cities. And I'm going to just pick on capital cities for now. Where you reckon?
Property. So property in capital cities.
Yep.
Gotcha.
Where you reckon Sydney's done in the last 30 years? Average growth rate, compounding.
7%.
7.6.
Yeah.
7.6. Not every city's like that, but.
Okay.
Melbourne, 8.1.
No shit.
Brisbane, 5.9.
No shit.
Adelaide, you've got 5.9 as well. List goes on as well. Perth goes down to 8. Oh, Perth is actually up 8.8%. So it's actually probably one of the best performing cities. Hobart, 8.5%. And then Darwin, 5.6%. So when you look at that, I guess my brain goes, okay, if you can get an 8%, a 5%, a 7%, you're doing quite similar to the S&P 500 or ASX, but then you're leveraging your money. This is where I like the compounding of this.
For sure.
And I think...
I can't disagree with you, buddy.
I think...
Because $100,000 growth on a stock is very different from $100,000 on property, because you put $100,000 of your own money, but you get the benefit of a $600,000 asset growing at 7%.
So I still ask you, why do you put your money in stocks if you can get a return like this? Let's just look at this.
Go.
Geraldton. People say capital cities are reliable, sustainable, they don't really have too much fluctuation.
Yep.
Let's go off Geraldton. I'll go off Newcastle.
So these are,
regional
towns.
These are
regional towns. Cool.
Newcastle's average 8.4% in 30 years. Geraldton's average 8.3%.
Awesome.
That's higher than capital cities. It's
higher than Melbourne.
Higher in Melbourne, higher in Sydney.
Yep.
You've got a property in Geraldton.
Yep. Should have bought two. Bought two, but then pulled out.
If you look at that, why wouldn't you've got as well, not this the 8.3%, since the last 30 years, the rents have gone up 410%. So cash flow wise, you buy a property, cash flow wise, probably be doing quite well, which we'll break it down in a second. But if you can annualize that over 30 years at 8.3%, don't you think you're leveraging your money? You can put 100 grand down for a 500 grand property. Away you go. Over 30 years, you do the numbers.
I'm with you, brother. I am absolutely with you. Is it slowing down my rate of purchasing? Yes, it is. Yes, it is, right? It is slowing down my rate of purchasing properties, right? Boo-hoo. This year I've got to buy 3 properties as opposed to 4 properties, right? The reason why I buy stocks is essentially the same reason why I buy. So just to give you an insight of why I'm buying stocks and what my goal is with stocks. I will get my stock portfolio well above $2 million by the time I'm 65. It'll be well above there, right? If I continue to do the same thing, 10, 20% of my income, I put it into it, which is, $4,000 a month I put into stocks. I might not do that for the next 30 years. Shit might happen, might drop to $2,000, might pop up to $5,000, whatever it is, but $4,000 a month. My portfolio, I've ran the numbers so many times. It could be at like $15 million by the time I'm 65. I will move that to a self-managed super fund. This is not financial advice, by the way. I'm not a qualified professional stock broker, so do not listen to this and take any advice. I will move that into a self-managed super fund. I'll have to do an off-market trade, blah, 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 blah. And essentially my
Will there be tax involved?
There'll be tax involved. I'm sure there's going to be tax. By the time we're 65, there'll be...
Who knows what's going to happen there?
There'll be some wild things.
We won't even be paying these unrealised gains on
it'll be a
minimum of $200,000.
We could all be, might not even be alive by 65, so we don't know. And I'll touch on that.
The way we're going. Are you going to touch on when we get to 65, what happens then?
No, I'm going to touch on why we might not be alive and why I still invest in stocks, right?
We'll keep going.
65, essentially what it'll mean is you put it in self-managed super fund, it's tax-free when you take cash out. So I could take out $500,000 a year, let's say, and use that as tax-free money to go and spend as I wish, right? If I take out, let's say I've got a $2 million stock portfolio, if I take out, call it $100,000 a year, and I use that as my passive income, portfolio goes down to 1.9 million, right? With me? Portfolio, and I use that cash, I go spend that cash, spend, awesome. The portfolio grows by 10%. It goes back up to 2 million. So it's literally a bank account that just never stops. That is my goal with it. For me, I'm like, if I enjoy the portfolio, if I genuinely do take a lot of joy out of being in it, and it also provides me with an extra safety blanket that I guess property doesn't provide me. God forbid anything happens with my income and I can't actually fund my portfolio, my property portfolio. For me, it's a nice feeling that I can rely on the stocks, even though it's not too much of a burden on me. Like, even though it doesn't take up too much time, too much energy, and I enjoy it. The reason why I said before, might not even be alive by 65, and I never say this, is because that's actually the truth. Might not be alive by 65. I actually want to have a investment in my portfolio. I've only invested in 2 things. I want to have an investment that I actually thoroughly enjoy. I don't even get involved in my property portfolio, but I am quite heavily involved in the stocks. So for me, it still works. I don't think you can I agree with you. It might not be the best financial decision. I don't think it's a bad one because it's doing really well.
You're doing better than most people.
Correct. So it might not be the best financial decision. I 100% could move that 250. I could buy an asset today for 750. I'm buying an 850 property today. It's costing me 250. That property is going to be worth 1.3, 1.4, 1.5 in the next 5 years. So I agree, it might not be the best financial decision, but it's maybe more so than just financial.
Okay.
So if you're an investor, don't listen to me because I'm clearly not the greatest investor. Don't touch my property portfolio. And I'm now emotionally invested in my stock portfolio. So that is a big no-no. But I think we're both at the point where we can do this.
Yeah, of course. And I think down the track, I probably will look into doing something like that.
So you're a phony?
Look, I'm not, but
You're a phony.
I'm not going to, I'm open to it, but not now. And I think I can get, and this is the reason why, is because I've already looked at my portfolio. I can outbeat that any day of the week. And I know you know, and you've done the same.
Of course.
And so when I put it all on my plan and on my spreadsheet, it's like, okay, well, right now I'm doing quite well. I know where the market's heading. I know what's happening in the Australian property market. I know where the best markets are to invest, like hence why we're investing there now. It's like, okay, or if I can put myself in a better position, when I get to a point where I've got cash flow coming from my portfolio, I'll use the cash flow from my portfolio, put it into stocks, use some of my income, put it towards there.
So is that the only time that you will then do it when you are providing?
Yeah, I think so. Yeah, when I get to that point, I think if I put all my eggs in one basket and just focus on growing that, you know, people listen to put all the eggs in one basket and they think, you know, you should go diversify. No, I diversify by buying across the country.
100%.
And that's how I diversify.
I agree with that.
Portfolio.
That's actually a good point.
And buying different assets too, like blocks of units.
Sure.
You know, you got your residential housing and then a commercial, and then there's going to be some probably rooming housing and different things like that in my portfolio, which I'm planning to do. So with that, that's my diversification. And so there's like people like Warren Buffett just does his stocks, building up companies, of course, as well, Berkshire Hathaway. You got Robert Kiyosaki, just focus on property. He loves gold and silver as well. Of course, he starts to diversify, but he done that gold and silver when he was already really good at property. Mm-hmm. So once you're good at one thing, you can start to say, okay, I'm going to start moving over and transitioning.
Yep.
So you could say, look, at this point in time, am I really good at property? Yes. And can I make that transition? Yes. But at this point in time, I don't feel comfortable.
Well, and to be honest with you, this is why I said it could be a mistake in the future. I mean, let's be honest.
Well, that strategy you've got there, it's a great strategy. And I've seen what you've done. I've gone to the seminars. It works.
100%.
It works. And if you're going to do stocks, I'll do it the only way I'll do it is that way because it's just the safest way and it's literally logical and you're not chasing the market. I remember I was trying to chase the market. I was trading. I was doing this and I was losing money. Yeah. And you're looking at it. You wake up at night time going, oh my God, it's dropped.
Yeah, I honestly, I don't even look at my portfolio. It's
one of the silly
things. Look at it on the first of every single month. And I look at it. Like I obviously watch the videos throughout the month, I'm part of this course, and that's it. I was going to say though, it could end up being a mistake. It could end up being a mistake for me potentially because I am stopping myself essentially from being able to buy, 2 more properties because of the stock portfolio that I hold or the cash investment that I put in every single year. So I know with Sebastian, our CFO, he's like, well, Adrian, like you can only buy X amount because that's what your savings allows you to do because you have to put that 20% of your income into stocks. So could look at it as a regret in the years to come. However, I also could look at it because there's pros and cons to everything. 2 years' time, it is also a safety blanket.
Yeah, of course.
I've got no debt and I've got, in 2 years' time, 3 years' time, however years' time, hundreds of thousands of dollars, if not millions of dollars sitting there at any time. I can say, yes, I'm going to pay tax on it. But it is also for me a safety blanket, much like having an asset with a very low LVR on it. It is a risk mitigator. Shit hits the fan, you've got that asset there, you can sell that asset. The beauty about with stocks, which we know, I can sell it tomorrow.
Yeah,
literally sell it tomorrow, I've got cash in my bank account.
Pros and cons
I can help you if you break your leg and you need money. Legit.
Yeah, it's true. I agree. So let's do a little case study or comparison for these 3 different types of assets, okay?
Let's do it.
Stock, property, and gold.
Let's do it.
Stocks, 8.6%, I said is the average for ASX.
Mm-hmm.
At the moment, I've gone 2025 value, the ASX trading around 8,600. Over 20 years, you get that same return. That turns into just over $19,000. So you've made 128% over 20 years.
So sorry, explain that to me a bit further. How much money have I put into the ASX?
So the ASX at the moment is trading at 8,600.
Okay.
That's per share.
Gotcha.
Per share. So if you want to buy multiple, Okay, you know.
Okay, cool.
So I'm just going off one individual stock. You buy it.
Gotcha.
It's worth 8,600. In 20 years, it's worth just over $19,000.
Awesome.
1.5.
Yep.
Okay.
Perfect.
We go for gold, 6.6% return. Okay. $5,000 trading your AUD at the moment. Mm-hmm. Not in 10 years' time. This is all 10 years' time. I said that wrong. Not 20 years' time. So in 10 years' time.
10 years. So 8,000 to 19,000.
19,000, 128%.
That's awesome.
Okay.
Okay. That's really cool.
Stocks, gold, 5,000 goes to 9,500 off the average of 6.6%.
Yep.
90% uplift.
Cool.
Okay. If we go off this, I'm just going to pick Melbourne. Melbourne at 8.1%. Buy $1 million asset roughly. That's what the median house price is at the moment. Mm-hmm. In 10 years' time, it's worth 2.3 million. Mm-hmm. Okay. 117%. Awesome. But the beauty is, of course, you've leveraged that. So you turn your 1 million to literally 1.3 million.
And even more so, you've turned your $300,000 deposit into 2.3 million.
Yeah.
And then obviously you've got a lot of that is the banks.
Now, the crazy thing is, if you do it the fresh start way, okay, we are averaging, since we started the business since 2020, 24%, okay, annually. Now, I'm not going to do it over 10 years because, once again, we haven't been in business for 10 years. We've been in business for 5 years. So I done...
Almost 6, isn't it?
Coming up to 6.
When is it?
It'll be May next year.
Should we have a party?
We should have a party.
Should we actually do something for that? Talking off topic.
We probably should do something for the team. It'd be quite nice.
Okay, cool.
Anyway.
Carl, what do we reckon we should do? Should we do something?
We'll leave it to Carl's hands. He can plan it out. We'll... Vegas. We'll go to Vegas. There you go. That is a man for an idea.
There's a man.
So let's just go for average price of $450,000 at fresh start. 24% for 5 years. That probably turns into $900,000. Okay. Which is 100% return on investment.
Yep.
Okay. Now, what I've done here, I just want to get some case studies of clients of what they've done with some of our clients.
Okay.
And the reason why I wanted to do this is because I think if you do it the right way and you get the best advice, you can outbeat the market. Mm-hmm. And I think when you look at diversifying, you look at ASX, you look at S&P 500, you can do this the standard way. But if you get the right advice, like you've gotten the right advice of this gentleman that you're working with.
Gentleman.
You look at the results you've been getting, 15% return on
a lot better than the average.
Yeah,
and that's going to be my
stocks,
argument here for you.
Yeah. So I've seen some of your stocks have done 20% or whatever it is in a year, individual companies.
Yeah.
So if you look at here, fresh start clients, got Anthony, bought a property at 275, worth 590, 114%. And we bought that in March 2021.
And it actually doubled by 2024. It was worth 550.
And he bought his second one for 350. It's worth 600 today, 71%, October 2021.
Yeah.
Okay.
I'm with you.
Natalie, 312, worth 600 grand now, 92%.
Yep.
September 2021.
Yep.
So I can keep going off the list, but it's
I want to hear it. I'm going to keep hearing it.
It's pretty interesting. Tom bought for 245, worth 535 today, bought in Feb 2022, 114%.
I'm with you. I'm here.
Yourself?
Bundaberg.
We bought that 412. What's that worth? 900 or
80, 900.
So about over 100%.
110%.
We've got Cullen Snedge. We bought a duplex for 340. It's worth 610 today.
That's cool.
80%. And we bought that in September 2022.
Yep.
Tom, another client, 420, worth 700 grand. Bought that in Jan 2022, 66%.
Yeah. So these are all 3 years. So I mean,
some of these are 3 years and they're still going today. So it's like, you look at that leverage of what those clients have got, the equity. If they were to sell that property, look at Miles. He paid 420 for a property. It's worth 800 today, 90%, 2021, Jan.
And that did 40% in the first year, I'm pretty sure. 42%.
42% in the first year.
That was our
Wimbo.
poster boy. I'm with you. Like, I really am with you. And I think there would be arguments. There would be so many people watching this who are gold special, or maybe not too many gold specialists, crypto specialists or stock specialists, or are really passionate about this, and you get up in your feels with it. I couldn't give a fuck. I'm passionate about stocks. Couldn't give a fuck. At the end of the day, if you are focused on one thing, I think this is the underlying message that you're trying to put here. If you're focused on one thing and you have got research level investor grade knowledge about that one thing, go hard on that one thing and you will be super, super, super successful. As you've just mentioned, you've gone through all the things. Everything's awesome. 100% over 10 years, 100% over 10 years. If you've got our approach, because we're not, I mean, I shouldn't say we're not special. We have a whole team dedicated to buying the best asset. That's why we average 24%. If you have the same ability in stocks, you will beat those averages that you've just said. Go hard at that one thing. Go hard at gold. Go hard at crypto. Go hard at whatever. I agree with you. That's why I have 98% of my wealth tied up in property. That the beautiful thing about property is you can leverage. The also shit thing about property is that there is leverage. There's a pro and con with that. It's debt. My portfolio cost me 100 grand this year. That affects my lifestyle. So there's added risk. There's tenants. There's humans. I don't like humans. So that's a negative, right? There's pros and cons with everything. I think the underlying message that you're alluding to here, which I think is very, very important, if you know your investment, go hard at it. That's it.
100%. Agree. So we'll leave that with you guys.
Beautiful.
Hopefully you got value. If you enjoyed this podcast, please actually like it, because it means that we can see it. We can see people enjoying it. And if you guys have any suggestions on topics, we'd love to also hear your advice also.
Yeah, for sure. And it actually does help us, because we are looking a lot into where our team is into what is actually trending or what you guys are actually enjoying. So if you are liking this stuff, it's going to essentially tell us, cool, let's start making more things around different asset classes or whatnot. But again, thank you. The podcast is growing. We're going to start getting clients on when we get back from Europe. Thank you again. Good. You did not sway me. I will say that. I'm still going to be investing in my stock portfolio. So you're going to have to go again for another one.
Maybe we'll do part 2.
Maybe.
2027.
Maybe when I'm 65, I'll say, hey, brother, here's my $20 million stock portfolio.
And then I might have a $50 million property portfolio.
I might have both.
And then
I might have gooder than you.
maybe. We'll see.
Done. Thank you again. See you next week.